Good afternoon. Welcome to o2h ChaiTime number 9. So we're cracking our way through these, and as we come towards the end of the lockdown, we'll see how we continue. We're going to have a number 10, but on our ninth ChaiTime, we're very lucky to have Luca Madison with us. And the theme really is to talk about having a balanced portfolio post-COVID-19 pandemic, because the equity markets have shifted quite a lot. And the surprise, most of us actually, I had sold earlier pre the pandemic. I thought I'd buy when it goes really low, and then it came back so fast and quickly. But now it's, I've just quickly checked, and some of the indices are an all-time high pretty much. The Biotech indices is overshot where it was previously to the pandemic. And now it's kind of, should I be reshuffling my deck as an equity, my own equity personal portfolio? And how do people view healthcare and biotech moving forward? Is this an area that people should be more interested in? And so to discuss these kind of thematic topics and what would represent a balanced portfolio post-COVID, is it any different? We're really lucky to have both Luca and Madison here, and particularly to discuss more the macro issues. Madison from JP Morgan. I'd like to, we'll probably sort of kick off with you. If you'd like to introduce yourself, and as you introduce yourself, maybe can you just give us a view of the markets pre-COVID-19 and your perspectives post-COVID-19?
Sure, big question. So nice to meet you all virtually. My name is Madison Fowler. I'm a global market strategist within the JP Morgan Private Bank. So my role is really focused on multi-asset class strategy in aggregate. And I think you asked a good question in terms of how everything felt before COVID-19. And so starting with the timeline, I think is an important one because a lot's happened over the course of just a couple of months. So I mean, on the pathway down to the bottom, cases were still by and large rising, and there was a very limited policy response at the time. And this was largely due to the fact that things had gotten bad really, really quickly. When markets bottomed, there were actually only around 43,000 COVID-19 cases just within the US. Now there's well over 2 million cases in the country, and there's roughly 8 million worldwide. Yet at the same time, the S&P 500's rallied some 40%. As you had mentioned, from the lows, we've seen corporate and high yield bond spreads tighten. Sovereign bond yields have, for the most part, traded within a narrow band. And so I think the biggest question for investors when we're looking at this is, despite the virus caseload and despite the economic toll, why has the market panic really dissipated and dissipated so quickly? And so as the market was rallying, we weren't really seeing any, positive economic news at the time either. During the crisis, global economic activity pretty much plummeted to levels not seen since the global financial crisis, or not really seen even on record for a lot of these different indicators. And so in understanding, I think, why markets we're rallying in the face of this, it goes back to, I think, 3 key things that we were talking about, in order to call a bottom in all of this. And that would be that we needed to see a peak and move lower in infection rates. You needed to see robust central bank stimulus and fixing some of those liquidity issues that were present as well at the start of the crisis. And you also needed to see a robust fiscal stimulus effort from governments too. And so pretty much by and large, we saw all of those tick off, one by one. And so that really helped markets inflect higher from their lows. And so as that policy response kicked in, both equities and credit, really inflected higher from their lows. One thing I would also point out is that I don't really buy into the whole narrative that the market is disconnected from reality in any sense. I think the market does incorporate all of the available information that we have right now. And so with that said, I tend to believe that the market is priced for what we know right now. And so when you look under the hood of the S&P 500, for example, while it might feel at a broad level, we're up a lot, when you take a look on a company by company level, some 160 companies are down 20% from their lows or more still. And so I think at the same time as the market has, incorporated winners like healthcare, tech, we mentioned biotech in particular, home improvement stocks, all of those, because of their weighting, their higher weighting and market cap weighted indices, those sectors have helped drive the broader market higher. While at the same time, you've seen a number of asset classes still suggesting weak growth. You've seen small cap stocks, banks, emerging markets, credit, even commodities, haven't fully priced in a recovery yet, and those are still lagging. They're much earlier on in their rebound. We're just starting to see those bounce off their lows now. So by and large, the full recovery is still going to take some time.
Thank you for that, Madison. It's a great introduction. So I'm going to ask Luke a question and ask him to introduce himself at the same time and tell us a little bit about Octopus as well. So for going from public and macro to sort of private companies, where we sort of deal in that space quite heavily as well. What are you seeing pre-COVID, Luke? How do you feel that you're reacting to the crisis? And are you seeing the same spike in this is crazy highs in terms of deal flow and valuations, or do you feel, or is it leveled off? Or do you feel that, privately we're going through something a little bit different on the ground?
Yeah, thanks, Sunil. So, Luke Hakes, one of the partners at Octopus Ventures. We're largely an early stage tech VC, running about 1.2 billion in funds under management, a third of which is really focused down on the healthcare space in its broadest sense. To answer your question, Sunil, I guess, it's really kind of informative to look at what was happening pre-COVID in the general venture market. So I think, firstly, there was kind of two things going on. One, a lot of money being raised by specialist healthcare and biotech funds. That was kind of a trend that we've seen for some time and was already happening pre-COVID. What was also already happening pre-COVID was, traditional generalist funds really becoming a little bit more specialist in the same way that we have, adding specialist capability. We were seeing a lot of people starting to talk about health. And we're also seeing a general shift away from, kind of VC heartland of B2C to more of a kind of deeper technology focus, of which health is part. So I think that was happening anyway. Then you have COVID. The whole world is focused on health purely for the last few months, nothing else in the narrative, nothing else in the conversation. And on the other side, what do we see? Well, it's now the hottest space that there ever was, really. So, when we look across our three verticals of investment, which is health tech, deep tech, and essentially fintech, we've got more deal flow than we've ever had on the health tech side. The deal valuations are standing up. There's a huge amount of competition, much more competition than we would have historically had. And all that talks to the sentiment around the fact that, this is a topic that's front of mind. If you get it right, everybody can see the enormous impact that you can have on society, but also the enormous potential returns that you can generate depending on the category you're going into. And so I think, really all it's done is accelerate a trend that was already happening. In terms of how it's affected the companies in our portfolio, in the private market, things obviously move more slowly with respect to, the external markets, simply because there's some dislocation. These smaller companies tend to be earlier on in their development cycle. There may not be a lot of trading history. They may be in technology development cycles. And so the macro environment tends to affect them less than the large public companies. That said, I would say that even within the category of private companies, healthcare companies in general have held up probably more strongly than any other category. And whilst we are seeing an impact, i.e. buyers delaying decisions, so companies that may sell to pharma or provide pharma services, for example, are definitely seeing those pharma companies delay decisions, maybe a quarter. What we're not seeing is contracts not being renewed, which we might be seeing in other categories like enterprise software. We're just seeing things taking longer. And so I think more broadly, on the other side of this, actually a lot of the companies that we're working with see more opportunity than prior, simply because A, you've got more investors coming into the market who are willing to invest in these private companies, and B, actually a lot of opportunities are opened up. And we're invested in a couple of companies addressing the clinical trials market. And you can imagine, how that's developed over this period with, a lack of appetite really for patients to go in hospital and be recruited. All of a sudden there's a kind of recruitment crisis in clinical trials that those particular two companies may be able to address, for example.
Thanks for that, Luke. It's interesting what you say, because I've lived through a few crises now. I think it's our third crash that been alive through and actively been employed or had my own business within. And when the crash sort of happened in March, we were kind of expecting it, because you could sort of see it happening, especially in the biotech and healthcare sectors where you know what's about to come. And then when it happened, we did slow the investments, and I'm on all these various boards of companies and angel networks and things, and everyone's discussing, okay, let's make sure, having learned from previous cash that we've got, and we discussed this earlier, we're making sure that the companies that you are in your portfolio have a cash runway of 1 year, 2 years, that you cut costs where you need to, because you don't know what may or may not come. But interestingly enough, it's, I think within the technology sector, people have had to, from what I've seen of other fund managers, had to cut back on costs, raise more money now just to insure, etc., and take that safety net. But if I look at the biotech sort of therapeutic space, which is more the drug discovery or where the pharma companies sort of operate, we're seeing new funds coming up left, right, and centre. I mean, as I said, I don't have all the data to support that, but I'm seeing new funds with 400 million and 700 million of new money coming in. And I don't know if that was something that was prepared earlier and they just sort of closed it now. I imagine it's something like that. But the biotech funds in general, they act longer term. And I haven't seen in our sector, at least, any lack of money coming into the sector. Valuations have really held up very well. So there's been no reason really, I feel, to panic fundraise at a lower valuation or take a haircut because of that. I think people are obviously more cautious in March and April. But in May and June, we've really seen a lot of activity like probably what you've seen. And we were discussing this earlier, that Octopus come more from a technology health point of view, whereas O2h come more of a drug or a biotech therapeutics point of view. And before we would probably never have overlapped, but now these sectors are really sort of merging. Maybe it's because of COVID and people are sort of looking at human health in general, rather than biotech or tech, and there's a grey area between. So Luke and I have been chatting about deals or working together on things, which probably a year or two ago would have been quite disparate at different sectors. So it's been interesting how sort of between tech and sort of traditional biotech, the landscape has changed. I'm going to ask Madison a further question now. Is within all the various asset classes, everything seems to be really high. You mentioned certain subsectors there's still buying opportunities there. Which of those sectors do you still think is ready to buy in those areas or companies which have not recovered? And secondly, what's your position on healthcare in general? I mean, I've been to various various macro conferences by JP Morgan over the last number of years, and I have seen a thematic positive on healthcare in general. You have been pushing this area traditionally for a number of years now, and you also hold the biggest conference that I know of for investors in this area. So it'd be interesting to get your view of healthcare, and has this changed pre-COVID and post-COVID as well?
Sure. Yeah. I mean, there's absolutely still opportunities in this market, and I'll touch on a few areas in addition to healthcare. I mean, even ahead of this crisis, for well over a year, we are really focused on what we've been calling mega trends, or secular growth areas of the market that we felt could drive growth in the year to come. And the three big ones were digital transformation, healthcare innovation, and sustainability. I think this crisis, due to its nature, has actually accelerated all three of those trends. And then there's a number, specifically just within tech, there's opportunities within the rollout of 5G, within digital transactions in the digital workplace, now that we're all working from home. We're even seeing that e-commerce has really remained quite strong, even in the face of different states and countries reopening. On healthcare, the nature of this crisis again means there'll be a focus on this in the years to come, especially as different countries try to plan for another pandemic if one ever does come. We're all well aware of the search for a vaccine and antivirals, but they're also really interesting, I think, biotech developments that we've been focused on, specifically how robotics are sterilizing mass surfaces, specifically treatments around gene therapy, oncology, and orphan drugs are all projected to lead sales growth in the years to come. On sustainability, we've actually seen high and consistent flows into ESG funds during this crisis, and most ESG leaders have been, outpacing or outperforming their traditional counterparts as well. And so I think this crisis as well has also, shined a light on increasing inequality, and companies have responded to the crisis in a way that protects employees and lends aid to the public as well. So, I'm thinking of, manufacturers that have started to make ventilators, or retailers that are producing protective garments, or even some liquor companies that have started producing hand sanitizer. So all in all, companies are really adapting to this change and going beyond their normal, protocol for business. And then, by the way, climate change isn't going away anytime soon either. So I think sustainability, by and large, also in a lot of ways is becoming our new normal. Your question, I think, on valuations is a really good one. Because of the rally we've seen, combined with lower earnings expectations for 2020, valuations are actually higher relative to their historical averages right now. But I think it's really important to take a longer term view on that. So even looking at valuations based on 2021 or even 2022 earnings. And so, when it comes down to investing in a company, for me, the question I always ask is, do I feel that I'm paying the right price for access to this company's future earnings potential? And when it comes down to, those three mega trends of digital transformation, healthcare innovation, and sustainability, I think that the innovation that we're seeing underway isn't fully appreciated or priced into markets yet. And as that innovation, ultimately filters through into earnings, I think these mega trends, really stand to continue to drive growth. And, those are all, longer term trends that we're really confident in over the course of the next couple of years. I would say on a shorter term basis, some more cyclical sectors, especially in the consumer space and industrials, even US financials in particular, as those start to catch up, I think some exposure to those also feels prudent as the recovery comes underway.
So Madison, before we get into the healthcare question, actually, what are you able to say for, what your balanced portfolio would look like? I mean, traditionally, we all talk about 50% bonds, 50% equities, and how those, subdivide within that. What is the balanced portfolio as of today for JP Morgan?
Yeah, so our process for, creating a balanced portfolio obviously hasn't, changed too much. Our due diligence process still remains, very much robust.
You still feel bonds are a good asset class to invest in, for example?
Sure. I'll get into that. I would note, we're a little bit underweight equities overall now compared to where we were at the start. Before this crisis hit, we were very much overweight. I would note that ahead of the sell-off, we were also taking more incremental defensive moves in portfolios though. So while we might have been overweight equities, we also were allocating more capital to the US, and we are also increasing our bond duration, given the late cycle environment that we were in at the time. But as the market sell-off, really took hold, one of our first steps was to increase our allocation to high yield. We felt that given the wide blowout that we saw in spreads, really across the board, we felt it offered an attractive risk return profile. And then more recently, we've been adding to non-US equities actually, while still remaining, overweight the US overall, but still underweight equities, marginally in an absolute sense, given that the macro data was starting to stabilize as the economy reopens. We're also seeing, improved relative value in those international developed equity markets specifically, and think that they're, poised for a modest catch up relative to US equities. I would stress again, similar to my point before, that we're looking at some more cyclical sectors again, specifically industrials, as the recovery is getting underway.
Okay, no, that's interesting. And so coming down to sort of healthcare specifically, or biotech therapeutics, are you able to sort of say how your position has developed in that into that sector and where you stand with that as of today? Do you feel people should be underweight biotech, healthcare, overweight? What is a percentage of the portfolio that you would expect one to have of this sort of asset class?
Yeah, we by and large still remain very constructive on healthcare. We feel that it stands to really accelerate As a result of COVID-19, due to the nature of the crisis and the stable growth that healthcare can provide, that's something that we felt was true before this crisis. We even have a much higher conviction during it. The trends that were already gaining a foothold before the COVID-19 pandemic, particularly telemedicine, will likely see broader usage and continued innovation. And so that's really in focus for us. And again, different areas of biotech like the orphan drugs, oncology, gene therapy are really, fundamentally changing how we view curing serious illnesses. So all that's to say is, our conviction in healthcare, if anything, has only increased as a result of this crisis.
So I'm going to force you to try and put a number on it. Obviously, you may not be able to answer it, but if you said, what percentage of your portfolio do you think one should have with a healthcare bias in general as a macro view?
Yeah, I unfortunately can't answer that question in this forum, but I very much like healthcare.
I mean, if you take
good answer. Go on, Nick.
It's 30%, right? So
I think the reason why I kind of thought this webinar would be interesting is when I speak to friends and other people who are invested outside of the healthcare and biotech, they are so underweight the sector. And I just think if people had even a moderate exposure of a few percent or 5% or 3%, it would bring so much money into the sector. And there's there's some Madison mentioned, there are some mega trends in our sector, whether she mentioned gene therapy, there's a whole skew of things, there's epigenetics or cell and gene, and there's a whole lot of drug discovery therapeutics that are coming through. And the big pharmas, I was just looking at the public market biotech, like the ETS, and the big pharma, they're all times high. So their balance sheets are pretty healthy and healthier than they ever have been before. And a lot of our little biotechs and innovative companies rely on these big companies to acquire them, to collaborate with them. And we can see that in tech and how it's benefited the tech sector. Amazons and Apples and Oracles and everything being so well capitalized that allows the little companies to do innovation and grow and hopefully get acquired or IPO. And I think the pharma companies are so healthy at the moment. It can only bode well for people coming with innovative companies in our sector. So that's why I thought it was interesting. So Luke, do you have a perspective on that further?
I think, just picking up on one of your earlier points, actually, around the kind of confluence of your world and my world in many ways, and why is that happening? And I think, in many ways, it's been driven in part at least by artificial intelligence and machine learning. In biology, you're essentially looking for patterns in data, and biotech and healthcare are kind of driven around identifying patterns and then creating products or treatments or whatever interventions to take advantage of those patterns that you've discovered. And, that was always smart individual scientists. And now, with enough data, you can start to ask the machine to solve those questions for you. And so a lot of the crossover that we're seeing, and where some maybe traditional VC funds or traditional tech investors have started to get a bit more comfortable in the biotech or pharma space, is actually saying, well, we kind of understand how this kind of technology works. We understand the application, and therefore we can join the dots to see that there's an opportunity here to streamline process, increase efficiency, do something that wasn't possible before. The main challenges, though, I think, and where you can get it quite wrong, are really understanding the difference between a company and a feature. So I see a lot of small companies, in inverted commas, that are really algorithms or features that should be bolted on to other technologies or integrated into other companies to actually be able to drive value, rather than being companies in their own right. And also just a lack of understanding around some of the people that are coming up with these novel technologies in terms of the kind of complex go-to-market that you find in healthcare. So, a lot of folks turn up, think they can apply machine learning to a biological problem, do so successfully, but without any kind of thought about how you might get that into the market. And as we know, the healthcare industry and healthcare systems are extraordinarily diverse across the planet in different geographies, and each one needs a slightly different approach when it comes to GTM. So that is a challenge that I think a lot of those companies are going to face and do face. But increasingly, as traditional tech investors cross that Rubicon, I think that's where they're then starting to get comfortable learning the vernacular in some ways of the world of pharma and biotech, and building teams to start to address it. And so, you know, you're accelerating that growth of expertise on the VC side, which, you know, should lead to a bunch of companies that essentially then grow and float up to Madison.
Yeah, so I mean, just to drill on one point, it's like, you know, this kind of crossover from tech into biotech. We've seen a lot of really great tech entrepreneurs looking to do that crossover, then they recruit people from biotech to help them and support them. Do you feel that we've got the management in the UK to support those types of companies, or is it something that we're developing and growing? And I can give you my opinion in the US, and then I'll ask Madison a related question.
Look, I think the UK is getting better all the time. You know, 10 years ago, I would have said, no, absolutely not. I think increasingly we are starting to get folks that haven't only worked in large pharma or large biotech, but have done or worked in either through starting the companies themselves or being present at a very early stage, some of the, you know, more high growth, more exciting biotech companies. And, you know, that talent is being recycled back into the talent pool. And so I think increasingly we have a generation of entrepreneurs who are, you know, teaching others, mentoring others, and those folks are then, you know, integrating back into the system. So I think whereas a few years ago, we had a lot of executives in the UK who were quite experienced large company executives. You know, we're starting to get the, you know, an increasing number of smaller biotech pharma company executives feeding back into the startup space, you know, and then crossing over into the tech space as those tech entrepreneurs look to try and, you know, hire relevant talent into the vertical that they're trying to address. So I think it is happening. As with anything in European, UK venture, you know, we're some way behind the US. I think we're catching up. We're catching up pretty quickly in terms of the development velocity versus how long it took, for example, the Valley to get from, you know, starting to where it is today. We're very much on an accelerated curve. And clearly there's a whole bunch of geographical crossover with people coming over from the Valley. You know, one of the great strengths of the UK is its healthcare, biotech, pharma landscape. And, you know, when you look at university research output, and I'm the chairman of Manchester University's tech transfer office, you know, almost 40% of the spin-outs that come out of Manchester, for example, are biotech healthcare spin-outs. So, you know, there's a huge wealth of kind of raw material, but there is still a challenge in turning that raw material in companies simply because of the lack of the talent that's available on the doorstep of those institutions.
Thanks for that. I mean, I think there's a more of a level playing field in this area, actually, because I do see in the UK that, you know, we have some very strong technology talent. They're trying to make that crossover. There's very few people that bridge both in the UK. There are a few people, but they're few and far between, who can talk the pharma language and happen to be a good tech entrepreneur as well, or come from that background. But it's actually quite a similar situation in the US. You do, in the companies that I've seen, have people that are either from tech or from biotech. So because this is sort of new and emerging kind of hybrid type of company, it's emerged equally. So I think it's one where it's interesting, and I think we can actually in the UK develop and grow at the same pace as the US. I won't say outperform. We do have clusters like Manchester, like Cambridge, Oxford. Particularly, obviously I'm in Cambridge, I can see around me we have billion-dollar tech companies across the city, and we also have big pharma that have come in to acquire biotech across the city as well. So we've got a number of big pharma names here, and you know, and it's a very small city. Although Cambridge sounds grand, it's, you know, obviously got the history. It's still only 100,000 people, pretty much 150,000 people in the whole of Cambridge. So you do get that real crossover knowledge effect, especially in the, you know, 5, 6, 7 science parks we have here. So I do feel that talent is developing and emerging at the same pace that it would do in the US in certain clusters. And Madison, you are a real American, so it'd be good to get your opinion. You're from obviously you worked in New York. Prior to that, you were from Florida, I believe. So what's your opinion of the talent that's appearing, this crossover between tech and biotech? Do you feel It's already developed and it's mature in the US now. And in terms of the companies and the valuations, maybe you have a perspective there. We've seen biotech, specifically valuations in the US, really be significantly more than the UK. Is that justified? Why do you think it's that?
Sure. I mean, you would probably have better insight than I would into, you know, the talent acquisition and the development of specific companies. But as far as, you know, valuations go, when we're looking at it, we're looking at the underlying earnings growth of the sector and of the different companies. And by and large, you know, for the healthcare sector as a whole, it tends to be not only high but also very stable. And so that's why we really like it from, you know, a multi-asset class perspective, as a secular growth perspective, because we feel that it can continue to drive growth in the years ahead. The only thing I would add, you know, as my American perspective, is that, you know, whenever we have an election season, we tend to see some volatility specifically in the healthcare space. So we might, you know, as the U.S. presidential election is upcoming in the next few months, we could continue to see that as we see the different policies that are touted by the candidates. I'm sure we, you know, remember the 2016 election when there was a, you know, a renewed pressure on drug pricing. We saw a lot of volatility in healthcare, so it's possible that we see that again. But I think by and large, the thing to focus on is just the long-term earnings growth projections, and that should drive growth over time.
I mean, that's an interesting point about the sort of the government interventions in the sector, but also from a macro point of view. How do you feel that the government's responded to this crisis, opposed to, say, the dot-com bubble, where there was probably very little intervention? Do you think we've done enough, given the scale of what we're facing? And secondly, particularly to drug pricing, do you think the Trump administration is going to continue along that line? I've seen them soften their stance in other industries, and given, I think that the pharma companies and the biotechs have really shown them to be sort of good corporate citizens, social citizens in this crisis. I really feel that they've stepped up in a number of areas. And I've mentioned this before, but, you know, if I have to speak to someone very senior in a big pharma and it's about anything related to COVID, I get a reply from the number one or number two guys in those companies straight away, whether it's forwarding on or connecting me, without a view to try to make money from it or anything like that. It's just trying to solve this crisis. So I really feel that the pharma companies have shown themselves to be good corporate citizens in this crisis. And I wonder if that's filtered into governments in the US and the Trump administration or others. And how do you feel that will affect?
Sure. Yeah, I tend to agree with you on that. I'll cover the question on, you know, government intervention now versus the dot-com bubble first. I mean, government stimulus has far exceeded expectations and will very likely go down in history as one of the most robust and coordinated responses that we've seen, you know, overall compared to any crisis. You know, it far exceeds, you know, not only what we saw during the dot-com bubble, but also during the global financial crisis as well. And so I think while it might be, you know, enticing to compare this crisis to the dot-com bubble because of the rally that we've seen in tech stocks, I would really stress, you know, how different this crisis is compared to the dot-com bubble. You know, that was really an example of a demand-driven crisis, you know, where you saw higher leverage and the buildup of an asset bubble that eventually burst. You know, the global financial crisis was also an example of this. But this crisis, you know, is really an example of an exogenous shock to the system, an example of a supply-driven recession where we saw the supply of goods and services just become totally restricted and shut down. And what we see when you look at these different types of recessions that have occurred over time, that these supply-driven recessions tend to recover much more quickly than demand-driven recessions. So that, and we're already seeing that play out. The economic rebound that we're seeing associated with this crisis far outstrips what we've seen in the examples of the dot-com and global financial crisis.
That's a great point. And so, Luke, before this call, we were talking about the various areas and government interventions that could result in new sectors of areas opening up. And one of the earlier ChaiTimes it had was on the antimicrobial resistance. And I think recently we saw the government intervene in this area, and now they pay for drugs based on how good they are rather than how much quantity of the drug that they use. Do you see government intervention supporting any other subsectors within this space, or do you feel it's a level playing field from now onwards?
I think we've certainly seen the impact that some of the moves towards AMR have had on the kind of number of startups that we're seeing in the space. So, you know, we've seen a surge in the number of startups that are addressing the AMR space through kind of novel approaches, quite a lot of gene editing and, you know, interesting techniques to try and, you know, remove antimicrobial resistance genes from organisms through various different avenues, which has been quite interesting. We're also seeing a kind of shift in, I think, investor sentiment because of that. As regards, you know, government intervention driving other areas, specifically in healthcare, you know, there's a lot of support for and grant money floating around, you know, for stuff in the telemedicine space, as we've talked about, and, you know, interesting algorithms that address some of the challenges that have cropped up. But I don't think necessarily that's going to be a huge driver. I think government's response more generally to the crisis in terms of supporting smaller companies and the companies that I kind of deal with has been pretty mixed. You know, I think, you know, the CBIL program probably doesn't work for anyone in my portfolio. You know, it tends to work for companies that banks would already lend to, you know, which tends to be not the businesses that you and I deal with, Sunil. You know, the future fund is pretty small in aggregate. So, you know, if you think about the total quantum of cash available versus the number of early stage companies in the market and the kind of typical quantum of money that those businesses would burn through, given most of them are burning cash, and it's a tiny, tiny fraction of the capital that was required by those companies in the market. But I think the government's view is, you know, if you're VC funded, then you know, it's down to your VC and the associated investors on your cap table to help you through this crisis. It shouldn't be a government thing. And, you know, there's already quite a lot of support from government for small companies through VCTs and EIS, et cetera, et cetera. And they're things they didn't want to mess with because you had to mess with legislation, and that's kind of understandable. But it would have been nice had the future fund worked nicely with some of those other structures.
No, I agree with that, Luke. And I feel that, you know, the government has taken unprecedented, they've really pulled out a lot of ammunition they had all over the place, and they fired their bullets. They've probably fired all their bullets, but they somehow have missed some of these smaller innovative companies, which are the engine of the economy, really, and especially more the EIS driven companies, which can't really take part in any of these convertible loan notes. They sort of miss those companies out. But I think biotech will be successful, and our sector in healthcare will be successful despite the government, not because of the government. And I think it's largely more driven by macro trends, by the big pharma, and hopefully that will carry us through and allow some of our innovations to come through to benefit patients. I'm going to ask a question here. It's probably, I guess, more directed to Madison, from David Cumming, who's one of the founders of the Spree fund. So could the panel comment on the fact that a large part of the return and recovery in public markets is attributed to a very small number of stocks: Apple, Amazon, Alphabet, Microsoft, Facebook, J&J, JP Morgan, Nestle, Visa. It's very concentrated and explains a disproportionate amount of the return. The average return on those 10 stocks from December end to May 31st, 2020 is 51.4%, but the average return of stocks in the MSCI World Index in the same period is 8.1%, and the average return of stocks excluding top 100 drops further to 5.3%. So I think that firmly drops in to your corner, Madison. Over to you.
Sure, yeah. Very fact-filled question. I enjoy it.
I expect nothing more from David.
No, I think you're absolutely right. And if anything, that gives me more conviction in the recovery, not less. I think that there were two ways this whole thing could have gone when we started to see healthcare and tech stocks rally so much. we could have seen those companies at the top start to crack and crumble and then bring the whole index down with it. The better way for it to all go is if we started to see those stocks that were underperforming, namely, you know, those beaten up areas of the market that are more cyclical in nature, start to inflect higher again. And so that's exactly what we're seeing, because we're starting to see those names and sectors that were more exposed to this crisis start to rebound. That means to me that investors are by and large growing more and more comfortable in this recovery. It makes me feel that the stock market can continue to grind higher. That doesn't mean that we're not going to see some volatility along the way. It doesn't mean that we might not see drawdowns here and there. But that inflection point, I think that inflection point really matters. And then as far as it goes for, you know, the names at the top, I think it goes back to what we said before. Absolutely, valuations are high. I don't think, you know, you can really get around that fact. But if you believe in the future growth and earnings projection for those companies, and you believe that they can drive growth in the years ahead, then it might be worth paying the higher price to do so.
Do you think we're in a bit of a bubble in some of those larger companies?
To me, I don't see a bubble for a couple reasons. I mean, one, you know, the overall growth trajectory looks stable to me, and it looks healthy to me. Even as we see companies take on more debt as a result of these different, you know, government programs that have helped prop the market up, they're doing so at really low interest rates. So those debt servicing costs are really, really low. So even if they're taking on more debt to fuel future growth, you know, it's sustainable in the sense that they can pay it off. And pretty much, you know, every major developed central bank has signaled that they're not planning on raising interest rates any higher for the foreseeable future. I think, you know, the Fed, when they came out with their last policy meeting, wasn't expecting to raise rates above zero until 2022. So that to me just shows that those companies, you know, have, you know, some longer leeway to keep doing what they're doing.
Thank you, Madison. I've got another question here, which I'll direct at Luke. And if you can see it in the Q&A, but I'll read it out for everyone who's watching. It's from Catherine Stace, and it's: with continued interest in biotech and healthcare throughout the pandemic, and perhaps an increase in funds available, do you think that this will raise the expectation of what small companies and their scientists can achieve with X amount of money, especially given the heightened public interest in government funding? And how do you think this will affect the value and downstream challenges faced by companies, particularly at the early stage? That's a great one for you, Luke.
Yeah, it's a great question, and I guess it really depends on the perspective of you know, expectation from who. So I think, you know, if you look at the investor market, typically when a huge amount of money flows into the sector, actually expectations of delivery against that capital tend to go down, because things get funded that historically wouldn't have got funded, or maybe weren't the best things in the market. So you tend to see actually a decrease in performance when there's a surfeit of extra capital thrown at an industry. So I think, you know, expectations from the investor standpoint, or certainly from a VC standpoint, are, I would say, there's probably going to be more failures and maybe lower performance. Clearly, you will find some fantastic companies in there, but in terms of raw numbers, you would expect more companies to fail. If you're talking about the perspective of government and, you know, how they view the capital that they provide and the expectations that come with that, it tends to be any time that there is significant public or governmental interest in a startup, expectations are always higher than what is actually deliverable for a business. So anytime that government has put money into small companies, I would say those small companies have always, in all likelihood, under-delivered versus what they promised whichever government organization was injecting that capital. And I think in general, the public's expectation of how long it takes to go from, you know, ideation through to a very valuable business or anywhere on that spectrum is much shorter than the actual reality. So I think unless you're doing this stuff day in, day out, and you spend a lot of time looking at small companies and what it takes to build a significant business from them, people tend to always think it's going to be easier and be much quicker than it actually is. So I think, yes, there will be greater expectation, and I think people will be disappointed.
Yeah, no, I think that's probably fair. We are seeing a huge amount of deal flow, and I think it's important for specialist funds like mine and yours to continue. I mean, we're able to do that level of due diligence and speak with big pharma before making investments if we need to do the fairly sort of high-level technical due diligence and lots of things. I've seen generous investors start to invest quite heavily in therapeutics and biotech. And I think that's fine if we're leading or if another fund that has expertise is leading, but it does worry me when I see generic or generalist funds because people need to invest in what they understand ultimately. And if funds are investing in things which are difficult for them to understand, I think that's will lead to a lot of failures, put a lot of pressure on management teams to deliver where business models may be or the technology is fundamentally flawed. So I think that will impact us. But I think it's specialist funds where we have the expertise. If you ask me to invest o2h invest money in a quantum physics product, we'd find it difficult to do due diligence. But if you ask o2h to invest into a small molecule therapeutics or an oncology target, we know exactly who to talk to. We can do proper due diligence on the chemistry. We can speak to other funds in the sector to bring in the best brains behind the product. And I think, I think when people invest, they just need to be cognizant of the fact that they're investing with specialists. I think your my fund would fit that bill, to be fair.
Yeah, I think that's right. And I wasn't down. It wasn't meant to be a negative comment. More generally, it was more one of, in reality, for those funds that do understand the market, there's going to be an opportunity actually probably to invest in assets that others may have funded but haven't truly understood, where they've got lucky, and then actually, those that do understand it can then pick it up slightly later stage, further de-risk because the initial capital's already been spent. So, I do think there will be quite an interesting situation that arises where, there are more companies more companies funded, more companies fail, but because of the nature of, large numbers, you get more opportunities to build some quite interesting companies as well.
Yeah. There's a question on pharmaceutical pricing and the pressure post-COVID. Do we feel this will change? I don't know who wants to have a go at answering that. Maybe Madison?
It's probably a better question for you two, to be honest. I think you could certainly see that. I think it's probably still too early to say. I would be surprised if that's something that we see come about quickly. I think everyone wants to see, a vaccine or an antiviral solution come quickly. So I'd be, surprised if, increased regulation and different controls come about sooner and stymie that process in any way. I'm not sure if you two have something to add to that.
I think from what I'm seeing and hearing, there's always been this pressure on pharmaceuticals. And I think what the industry or the general public don't like is these massive price hikes for orphan indications. I think that's been very difficult from a public company perspective, or for the public to absorb and understand that sort of development costs, so that they have to be controlled and managed. And I think there is always this pressure on pricing, but we have to, the reality is it does cost a lot of money to plow into innovation. It's not just a pharma company making money, it's a whole innovation or engine behind them, and a community of companies that support them do that. And it is very expensive to provide that innovation. And unless we have the margins in the product, it's not going to attract the best talent. We're not going to be able to create those innovations, create those vaccines within a year, which is what we're doing. So I'm not saying that we should forget about this question of pricing. I think it just needs to be balanced. The argument needs to be balanced with the fact that innovation is expensive, and there's a lot of companies within the ecosystem that need to exist in order to make it happen. Luke, do you have a perspective?
No real perspective other than to say, I think, as you said, the trend that's been ongoing, and I don't see COVID doing anything other than, being neutral or accelerating that trend. So pushing it the other way. Yeah.
I think we just need to be confident that there's real massive people that take a real massive advantage of a drug that's only available to a small number of people. They buy it and they hike the price up. I think that's not easy for people to stomach, and it feels wrong from a patient perspective. So I think on that note, I'd like to sort of wrap it up. I think really thank you both for making the time today. I've really enjoyed the discussion with you both. I don't know if you've got any last comments that you want to finish up with, but if not, Madison, Luke, thank you very much for both for your time today. There will be a Chai Time number 10. I haven't quite decided what the topic will be yet, so I can't announce it today. But I'm speaking to some quite good speakers that could join us for number 10. And so we will thank everybody, thank all the people for listening as well. Appreciate your time. Have a good weekend, and we'll see you next Friday. Thank you and goodbye.
Thank you.
Cheers, everyone.
Thanks both.